Hello class and welcome to week 4. I can't figure out why my camera is upside down. I promise that I'm not hanging upside down while I'm doing this. So I'm going to turn my camera off and you are going to be stuck staring at my screen for the rest of this video. Enjoy. Over the past 5 years or so in your accounting classes, you've focused on doing this, recording those journal entries, making sure your debits and credits are exactly right, and ensuring that our entries are properly posted to their ledger accounts. And that's important, but what's way more important than getting those journal entries exactly correct is those financial statements. How do those business transactions that we normally focus on, the recording and the journal entry, how do those business transactions affect the financial statements, specifically the income statement and balance sheet, and also the statement of cash flows? Managers of the company are not concerned about the debits and credits. They want to know how those transactions affect the financial statements. Shareholders and other financial statement users, such as creditors, they're not going to see any of the journal entries that were recorded. They're going to see the financial statements. So this week, we're going to take a look at business transactions and see directly how they affect financial statements. We're going to need this as a foundation because once we start a ratio analysis next week and continue that over the rest of the semester, we're going to also be able to, we must know how to determine how business transactions not only affect the financials, but affect financial ratios. Let's turn to our example and please work along with me. New Concept Technologies sells electronic devices including smartphones, fitness watches, tablets, and laptops. The company began operations in 2022 when it incurred the following transactions. We're going to go through each transaction and see how it affects our accounting equation, the statement of cash flows, and net income. First transaction, the company issues $500,000 in common stock. So let's start with how does that affect the statement of cash flows. Cash flows is going to increase by $500,000. And where are we going to see that classified? Operating, investing, or financing? That's going to show up in the financing section. Let's turn to the balance sheet. When we issue common stock, we know that we're going to be receiving $500,000 in cash. And stockholders' equity is going to also increase by $500,000. And that account is common stock. No impact to net income. Transaction 2. The company purchases a building for $720,000 by signing a note payable with the bank for the same amount. The note has a 30-year term and a 7% interest, which is due annually. The building is expected to be used in operations over the next 30 years. The company uses straight-line depreciation, no salvage value. The company, what we're doing here, record the purchase of the building and the issuance of the note payable. So to start, cash flows are unaffected. We are getting a building and we're in exchange agreeing to repay $720,000 plus annual interest. Nothing to the statement of cash flows. Our assets are going to increase by $720,000 related to the building. Liabilities are going to increase $720,000. And this is because we've signed a notes payable. So our notes payable account is going to increase. This will be in the long-term liabilities section. Nothing happens to equity, nothing happens to net income. If you're wondering about that interest, well, let's wait until time passes. This is the entry for the day the building is purchased. Interest won't be recorded until either it is paid for in cash or the financial statements are about to be prepared and we record our adjusting entry. We'll see that adjusting entry in a little while. Transaction 3, the company issues $40,000 in 20-year bonds payable at face value. The bonds have semi-annual stated interest rate of 6%. The proceeds will be used towards the purchase of equipment. But what we are recording here is the issuance of the bonds. Let's see how issuing bonds affects the financial statements. Well, we're receiving cash when we issue bonds, so we're going to have a cash inflow in the statement of cash flows. And that's going to be recorded in the financing section of the statement of cash flows. Because we received cash, our assets are going to go up by $40,000. Specific asset, of course, is cash. And again, just like in the last example, liabilities go up. Another long-term liability, the specific liability here is bonds payable. No impact to equity, no impact to net income. Transaction 4, the company purchases $45,000 of equipment to use in operations over the next 5 years. Straight line depreciation, no salvage value. What we're doing is recording the purchase of the equipment. So we are paying out cash. This is the cash we just received, plus an additional $5,000 from the bonds payable, plus $5,000 of our own cash. So cash is going to go down $45,000 when we're buying equipment. That is classified as an outflow in the investing section. So of course our asset cash is going to decrease by $45,000, and another asset equipment is going to increase by $45,000. And so what we're going to see here is that there's no net impact of this transaction on assets, liabilities, equity, or net income. Assets are unchanged because one asset goes up and another one goes down. Now, what about the use of the equipment and therefore the depreciation expense? We'll see that in a separate entry further on. Transaction 5, the company purchases inventory of $20,000 on account. Well, if it's on account, then obviously the statement of cash flows is not affected. We get one asset, inventory, so assets go up $20,000. The specific account is inventory. And this was on account, we have to pay for this sometime in the future. So liabilities are going to increase by $20,000, and the specific liability is accounts payable. No impact to equity, no impact to net income. Transaction 6 says the company sells inventory that cost $15,000 to customers for $28,000. The sale is on account and payment is due from the customer within 30 days. So because the sale was on account, we do not have any cash increase. Our assets, we have something to record here under the asset section. We sold inventory worth $15,000. So we see a decrease in the asset account inventory, but we also have an increase in the asset. We didn't get cash, but we have the right to collect cash in the future. So we have an increase of $28,000 in accounts receivable. And we can note that this is going to end up being a net impact to assets of $13,000. Nothing happens to liabilities. Now something does happen to net income here. We get revenue of $28,000. This is our sales revenue. And we decrease net income by $13,000, and that would be the account cost of goods sold. So of course we would see that net income, sorry, that was $15,000. Net income increased by a net $13,000. Okay, so we see here our accounting equation doesn't balance. Now it will by the time we prepare our financial statements, because what happens with those revenues and what happens with those expenses at the end of the accounting period? At the end of the accounting period, all of the revenues will increase stockholders' equity through the account retained earnings. So if we assume that closing entries, instead of being recorded one time at the end of the period, were recorded each time, we would see the other side of our accounting equation balancing. We'd have an increase of $28,000 to retained earnings, and then for that revenue, and we'd have a decrease of $15,000 to retained earnings because of the cost of goods sold. Transaction 7, the company purchases a patent from a competitor for $15,000 cash. Patent has a 10-year useful life, no residual value. Record the purchase of that patent. All right, we're paying cash, so clearly cash is going to decrease by the $15,000. This is a patent we're going to have for 10 years. This would be considered an investing activity, a long-term asset. We paid cash. Cash is going to decrease by $15,000, and then we received an asset worth $15,000. And we can see here that we have no net change to assets. Nothing happens to our liabilities, nothing happens to equity, nothing happens to net income when we're simply exchanging one asset for another. Transaction 8, the company records $6,000 of research and development expenses, which were incurred this period and paid in cash. So if we paid cash, cash decreases by $6,000. This would be considered, R&D would be considered part of our operating activities. In the asset section, cash decreases $6,000. And we don't have an asset for this. If you remember back to our accounting for R&D costs, they are expensed in the period incurred. So we would see a decrease of $6,000 to net income through the account R&D expense. And if we want to see how this affects both sides of the accounting equation, assume that once that closing entry is recorded, that $6,000 expense would be recorded as a reduction to retained earnings. In transaction 9, the company receives $4,000 cash from the customers that were related to a sale that had been recorded earlier. All right, so we're getting the cash. Cash is going to go up by $4,000. Under the asset section, let's show that cash went up $4,000. And then what's the other side of this transaction? We're not recording a sale. We had previously recorded the sale. What we need to do is remove the account receivable. And so what we see here is that when we're collecting cash from our customers to a sale that had previously been recorded, we have no net change to assets and no impact, of course, to equity or net income. Transaction 3 says the company pays $13,000 cash for the inventory that had been purchased earlier. So clearly we have a cash payment. That cash payment for inventory is an operating cash flow. Under assets, we need to record that $13,000 cash payment. And then what's the other side of this entry? It's not to inventory. We had purchased the inventory earlier in a previous transaction. We are paying off an amount we owe. So we are reducing our liabilities, $13,000, and that specific liability is accounts payable. No impact to equity, no impact to net income. Transaction 11 says the company is sued by a competitor for patent infringement because one of this company's products relies on a technology that was developed and patented by the competitor. The company loses the case and pays $50,000 in legal fees. Well, legal fees must be paid in cash. And this would be an operating activity, the legal fees. Cash goes down $50,000. And the other side of the journal entry would be an expense, a lawsuit loss, lawsuit expense. And so we would see net income decrease by $50,000. The account would look something like lawsuit loss. And if those entries were closed to retain earnings, let's say daily, we would see retain earnings decrease by that $50,000 for the expense, which reduces retain earnings. Transaction 12 says the company records depreciation expense of $2,750 on the building and equipment. We know that depreciation expense is a non-cash expense. It has no impact to cash. Cash flow is left blank. We will see a reduction to assets of $2,750. And the specific account is our contra asset accumulated depreciation. The other side of that journal entry would be an expense, which of course decreases our net income. We would see the account depreciation expense, and assuming that the entry was transferred to retained earnings immediately, we would see the offsetting decrease to stockholders' equity in the account retained earnings for that closing entry. 13 says the company pays interest accrued during the period of $4,200 on the loan from the bank. We're paying interest, so cash is going to decrease. Cash payments for interest, remember that's a tricky one, that is an operating cash flow. Let's record that cash payment. That's going to decrease our assets. And the other side of this journal entry would be interest expense. Assuming that we immediately recorded our closing entries, we would transfer the balance in our expenses directly to retained earnings and reduce stockholders' equity. 14, the company records bad debts expense for the period of $1,000. Remember, bad debts expense, this is a non-cash expense. We're saying some of our receivables will never be collected. If we recorded the sale related to that receivable, let's record the additional expense, the fact that some of those sales will never be collected. When we record bad debts expense, obviously one side of that is bad debts expense. That will reduce our net income. And the other side of that journal entry is a decrease to assets. And remember, we're using that account, it's another contra asset, allowance for doubtful accounts. Transaction 15, the company records $125 of amortization on the patent. Amortization, like depreciation, like bad debts expense, is another example of a non-cash expense. Nothing's going to happen to cash. We will have a reduction to assets, and this will be accounted for in one of two ways. The company can either, GAAP allows for the companies to either record that decrease directly to the patent or intangible asset account itself, or sometimes companies set up accumulated amortization accounts related to that patent. The other side of this journal entry would be a decrease to net income. We would see the specific account amortization expense. And once that entry was closed at the end of the accounting period, we would see a reduction to retained earnings. The next entries will be recorded in a separate part 2 of this video. Let's assume that we move to the next accounting period, and in transaction 16, the company pays $6,000 of dividends to stockholders. To begin recording this, cash flows are going to decrease by $6,000. Cash flows related to dividends, remember, are financing activities. Of course, we're going to see a decrease in cash. Assets are going to decrease by $6,000. And what's the other side of that entry when we record dividends? Retained earnings decreases. More specifically, we might see a dividends account decreasing stockholders' equity. And then at the end of the period, that dividends account will decrease retained earnings. The dividends account will be closed or transferred to retained earnings. Really important to note that when a company pays dividends, there is no impact to net income. Dividends are not expenses. Expenses are the costs incurred to run the business, and dividends are just simply taking cash out of that equity ownership of the company and giving it to the owners. Transaction 17 says changes in technology related to the equipment being used in operations resulted in the equipment being impaired by $5,500. The company records the impairment of the equipment. Remember that the entry to record an impairment does not affect cash flows, so we're not going to see anything under the statement of cash flows and no change to cash under our assets. We will see a decrease to assets of $5,500. And that decrease is going to be one of two things. It's either going to be an increase to accumulated depreciation. And remember that accumulated depreciation is a contra asset. So to increase the account, we record a negative. When we increase accumulated depreciation, assets decrease. Now, the other thing that could have happened is the company could have recorded the decrease directly to the equipment account. Let's assume that the company increases accumulated depreciation. And the other side of that journal entry would be to net income. We're going to see a loss on the income statement, a $5,500 loss on impairment. And that's typically going to be reported in the non-operating section of the income statement. Assuming that the closing entries were recorded right away, this would lead to a $5,500 decrease in retained earnings. Transaction 18 says the board of directors decided to invest some of the company's excess cash in treasury stock. The company purchased $80,000 worth of its own stock from the market. So to buy stock, the company had to spend cash. Cash outflow related to purchasing the company's own stock or buying treasury stock would be reported in the financing section. We're going to see the $80,000 decrease to the asset cash, The other side of this transaction, remember, treasury stock is not an investment security. Even though the company's intention could be to treat it as an investment, it's not, that treasury stock is not an asset. It is a contra equity account. So when the company buys its own stock back, rather than decreasing common stock, which is exactly what's happening, the company decreases stockholders' equity by increasing the contra equity account called treasury stock. And again, important to note that there's no change to net income. Transaction 19 says the company writes off $1,000 of its accounts receivable as uncollectible. When we write off the receivable, we do this when we know a particular customer is not going to pay us. We're not going to collect from that previous sale on account. This will have no impact on cash flows because we're actually not ever going to get the cash. We want to act as if that original account receivable we had previously recorded at the time we recorded the sale never took place. So we are going to decrease accounts receivable. And then the other side of that entry is to increase the contra asset allowance for doubtful accounts. When we first recorded the allowance for doubtful accounts, we decreased assets. We said some of these receivables will never be collected. Well, now we know that it's not collected, so we're stripping it out of accounts receivable, and we're taking that initial estimate in the allowance out from that allowance balance. We're not going to see anything on net income, no change. When do we see the expense related to not having the receivables? That was earlier on when the company estimated bad debts expense. That was here in transaction 14 when we decreased assets by increasing allowance for doubtful accounts and recording the expense to the income statement. I noticed that I didn't put, if we're going to do our closing entries immediately, we should also see a decrease to retained earnings in transaction 14. Transaction 20 says management determined that the equipment was not suitable, so it recently impaired it, and then shortly after that realized this equipment is not working out for the business. It sold the equipment. The equipment had a book value at the time of $38,750. Remember, by book value, we mean the asset's cost less the accumulated depreciation recorded till this point in time. They sold the asset worth on the books $38,750 for $36,000 cash. Now we see a cash inflow, $36,000. Cash that we receive for selling equipment, a long-term asset, would be in the investing section. Of course, in their assets are going to increase by $36,000 related to the cash that we receive. Assets are also going to decrease by the book value of the equipment that's going to come off. If I want to break down to get specific about the book value, I can just take off $38,750 for a book value. But if I want to get the books exactly right, what I would want to do is take off that $45,000 equipment we booked in one of our first transactions, and then I would increase or add back the accumulated depreciation that had been recorded so far. Remember, accumulated depreciation, when we increase it, we decrease assets. So now we're going to decrease accumulated depreciation, which currently has a balance of $6,250. So if we put together this $45,000 decrease for the sale of the equipment, plus the increase to assets of $6,250, that's going to net us the $38,750 book value. But when we add these three things up, we see that our equation doesn't balance. What are we saying? We got $36,000 cash in exchange for something that was worth on the books $38,750. That difference we would record as a loss on the sale of the equipment. So on our income statement, we're going to see a loss of $2,750. It's typically going to be recorded in the non-operating section of the income statement. And assuming we immediately recorded our closing entries, we would see the decrease in stockholders' equity through the account retained earnings. Transaction 21 says the company enters into a lease agreement to acquire new equipment. The 3-year lease is classified as a finance lease and requires the first lease payment to be made at the end of the first year. On this lease commencement date, the right-of-use asset and lease liability are $42,000. So we're recording the fact that we've entered into this agreement, this lease agreement, and we now have the right to use this equipment for the next 3 years. So let's record the increase in assets of $42,000 using the account right-of-use asset. And then we're also going to record an increase in liabilities, showing on the books that we owe related to this lease that we've just entered into. No change to net income. When we will see that change to net income is when we make that cash payment, we record the interest expense, and we record the usage of the right-of-use asset. Transaction 22 says the company reissues half of the treasury stock that was purchased earlier and receives $50,000. Obviously, this is going to increase statement of cash flows. Cash from financing activities are going to increase by $50,000. The company is selling stock, so it gets cash. And what is it doing? It's reissuing shares of common stock, but because when we bought them, we recorded them as treasury stock. Now what we're going to do is reduce the contra equity account treasury stock. So we are going to increase stockholders' equity by $50,000 using the account treasury stock. Now, if we want to get more specific, if you remember back to intermediate accounting, when we sell our treasury stock, what we technically do is increase the account treasury stock for the cost that it costs the company to buy this, which would have been $40,000, half of the initial $80,000. And then we would put that, not quite gain, but that difference that we received in cash over what we paid to buy those shares, we would put that additional $10,000 in another stockholders' equity account called paid-in capital in excess of par treasury stock, or additional paid-in capital treasury stock. For our purposes, it doesn't really matter. Let's just put it all together into treasury stock. Notice that net income is not affected, even though we reissued these shares at a greater amount than we bought them for. Our last transaction here, 23, says the company uses the $50,000 of cash received from the sale of the treasury stock to pay down some of the note payable with its bank. So we are giving up cash. Cash decreases by $50,000, and this is to pay off a note payable. So again, this would be a financing activity, financing cash outflow. Cash goes down by $50,000. And then the other side of this transaction is our notes payable account would decrease by $50,000. And that's the end of recording our business transaction into the accounting equation, so we can see each transaction's impact on our 4 financial statements. Make sure that you can walk through each of these examples without using your notes, maybe without this video. Print out the blank version, work it through without the video, make sure you're coming up with the same answers. And we will meet in class on Saturday to talk about this more.